tell you to. We need to meet. Okay, let's meet at the studio. Okay, I'll be there in 5.
My name's Pricila and
And my name is Jordan Hemp,
and you're listening to Off the Market Confessions,
where we talk about real stories, real estate, and real life. Welcome back to Off the Market Confessions. Today we are joined by one of our special guests, Francisco Cardenas. Priscilla, go ahead and introduce him.
So Francisco is a Yakima's pro golfer. Just kidding. He's a golfer, husband, a dad, and he's a lender. He's a lender that I use actually probably 99.9% of the time. So yeah, welcome to the pod, Francisco.
Thank you. Thank you. The male.
The first male on the
First
pod.
male guest.
First lend-
Yeah. First lender, first male, and the first person that we feel like we know enough that we don't have to use any special notes for.
Yeah, there's no notes, so
Mhm.
I don't even know what's going to happen.
Oh, we're just going to wing it. It's no big deal.
Yeah, tell us a little bit about you. Like, I know you grew up here, but tell us kind of like how you got into the lending world
Yeah, that's
and golfing world.
Oh, yeah. Tell us about golf first.
PGA Tour.
Consumed a lot of my life recently, last years,
Mhm.
but it's been good. Met a lot of people through
Mhm.
golf, and it's kind of I used to think golf was like boring and never would watch it, and was like, why
Mhm.
do people do this? And then now I'm like, why do people not do this? But no, I grew up, born and raised in Yakima. I went to East Valley, graduated from East Valley.
Red Devils.
Big Red or Red Devils. There's some
Wait, are
controversy
you East Valley too?
Yeah.
with the devil part of it.
Both of you devils? Bye. Just kidding.
So
It
it's
makes
like-
sense now, doesn't
It
it?
does make sense. Oh my God. This is going to be a beautiful friendship.
It already is.
Okay.
But yeah, 2012. I think like 2 years later, I got into like the banking side of things. Started working like as a teller at the credit union here, and then just kind of I was there almost 10 years actually.
Wow.
So like during that time, like started as a teller and then kind of worked my way into like the back office part of things where kind of saw how everything worked, like all the bank system
Mhm.
worked together. And then I went into financing, like the finance side. So I started with like car loans and credit cards, personal loans, HELOCs actually, which is kind of
Semi-real estate. related.
semi-real estate. And then I think I did like 3 years of that, and then eventually moved into the real estate side of things, mortgage, like financing side. And then that's where like I got, like, I think once I did the regular loans for like 3 years, it just kind of got like, so it was like the same, like it's a lot more plain on the consumer lending side of things is what people call it. And I was just like started to kind of get bored because it was like you look at a score, you look at their income, and then you're like, you don't meet this credit requirements or no or yes kind of thing. But then once like I kind of started talking to people about mortgages, and then there was just like so many rules with mortgages that it like got pretty like interesting, I guess. Like it was like a puzzle or game, like to put together different scenarios, and because you can make a lot of things work in a mortgage within like the guidelines that they place on like each loan. So it was a lot more interesting. And then like I've talked to guys at that point that were doing it for like 15 years already, and they would say the same thing like that I'm saying now. It's like it's always different. So there's like
So it keeps it interesting. Yeah.
so it's always interesting. There's never like one. I mean, there's every now and then you get kind of get like a good scenario. It's like an easy borrower and they meet all the like normal criteria. So it's
Those are my favorite.
Those are the favorite ones.
Easy
Those
ones.
You
the
guys
easy
just like
ones,
the easy ones.
like people that have done their stuff.
I'm sorry I send you all the hard ones.
But those are the fun ones because then you can
Mhm.
make it work.
They're challenging.
That's
The creativity behind it.
Yeah.
So yeah, I did, and now this is my 6th year doing mortgages.
Yeah.
What year did you leave Celerity? I know it's Celerity. We can say that, I think.
Okay. So I left Celerity middle of 2023.
Really? Oh my gosh.
So I was
It
doing.
hasn't even been that long.
Yeah, it hasn't been that.
I remember when you were there and I was selling real estate already because I started in 2020 and you were 21, right?
Yeah.
And yeah, I remember you being there and I remember we moved to Q Home Loans.
Yeah, so that was
I didn't
like,
realize it was
it was
like
it was
kind of
of
after the peak of the market almost. That
was kind of
22
the-
was kind of a peak.
literally like the time that I moved. It was like the worst time in the market, like middle of 2023,
Because rates are going up.
because rates at that point.
Yeah.
I think later I left in July, and then in October is when rates like peaked and hit like the 8%. in October. And that was like when I had just started at Q too.
But you didn't start at Q.
No, but I didn't start it.
He didn't
I
start.
had a,
No,
I
I
had an
forgot.
interesting way into moving into like
Mhm.
so there's two different sides. Like when you're at a credit union or Solar or a bank even, it's a different world, even though we're doing the same thing, because it's usually you're like paid a salary or like hourly wage, and then you get like some sort of commission. But once you leave that and you go to like Q or where I started originally, came to Keller Home,
Keller, yeah, I
Right.
remember that.
which we'll talk about. But yeah, then you go into strictly commission.
Not Jordan not knowing what that is.
No. I know, but is Keller Mortgage even a thing anymore?
It is. So yeah, family reunion. They were at family reunion. I sent him a picture. I said, you could have been here.
So yeah, when I moved, I went to Keller first. Basically, I was there like literally a month, maybe, because during all this, it was again an interesting transition. And there was apparently like some sort of contract already in place with a different mortgage lender,
In our office,
Academy,
yeah.
that was already gonna had already plans to come in and had an office in here.
Right.
And so like I think it was like the weekend before I was like gonna be here like for the first day in office, my boss called me and he's like, "Hey, this is going on, and like we'll figure it out. Don't worry." Like they're really cool about it. Like they were like looking at other options basically to make it work. But yeah, I had a month here where I met a lot of people like Priscilla and Jordan, and then yeah, after that, like basically the other lender Academy came in, and then I was like basically working from home at that point. So
And that I feel like was hard. I remember the first time I walked by your office and I was like, "Hey, did you go to East Valley?" And then we kind of connected over that. But
yeah, so
that would have been hard because like working for a mortgage company that's so closely associated with our office, but not being able to be in the office.
in the office, yeah, it was like
Was that the big reason to leave?
that was kind of the reason. Like they were pretty nice again about like finding me another office somewhere. And in my head, I was just like, well, I mean, long term, I don't really see this. Like, how much effort are they going to like really put into me? Like,
Right.
it wasn't what I like had signed up to do.
Yeah.
So then at that point, that's when I was like, well, I gotta make a move into like somewhere that's like here.
Right.
So that's where I moved to Q. So that was like in October of 23. And then that was a fun experience too. Long story short, I stayed at Q for like less than a year and then moved back in like April or May of 2024. Tony Andrews, he was at Q before he was bringing in Synergy One. So that's where I'm at now. Synergy One Lending. Shout out Synergy One Lending.
Yeah. We probably should have said that from the beginning who he works
Oh
with.
yeah, he works. He works with Synergy One. I'm sorry.
Synergy One Lending.
I'm
yeah.
sure
Black and yellow and white logos.
Yeah.
A lot of colors.
A lot of colors. And
Oh,
I'm sure
really?
if you, I'm sure when they see your face, they already know who you are. I don't even think we need to introduce Francisco, but
That's who I am.
this is kind of funny, I think, because I think a lot of people think me and you have worked together prior to us working together now. But really, I only met Francisco when he was with Keller. That's when we met. And I used to have a booth at the fair and he came by with his wife. And then I think I had seen you at a meeting before, but you said something like, or I said something like, "Oh, you should come." And then you came.
So, hey, do you want to get coffee?
Did you? No, you didn't. No, you said something like, you ended up at the booth like within the next like few days. And then that's how we met each other. Yeah.
Oh, nice.
And then here we are killing it together.
Yeah, I closed one deal for her.
The rest is
And he
history.
did. Yeah, he did. We'll get into details on why I work so much with him. But
Yeah. I think the Keller hiccup or whatever, the Keller mortgage hiccup that you went through was actually probably like a blessing in disguise for you, because had that worked out, who knows where you would be now. I mean,
Actually, looking back, like
it was a one-man show. You were here by yourself. And like, our office has fluctuated in size too. And it's, gone down further over the last couple of years just because other brokerages have come to town and people usually move when something new and shiny is around.
when they think the grass is greener,
If you were,
it's never greener now.
That's right.
The grass is greener where you water it.
Right.
The only way that the grass is greener is if the grass is fake. Period.
Put that into perspective. That makes a lot of sense.
I mean,
actually.
it's true. Really, the grass is only greener when you water it. If it's greener than yours, it's fake.
Yeah.
So
Yeah. Nobody's gonna water your grass for you either.
actually, they might. I'm just kidding.
Whatever.
Yeah, if you pay him enough.
Yeah. Oh, yeah.
Sometimes
That's
you don't
right.
gotta pay that much.
Not everybody's hot, Priscilla.
No.
There's margins out.
No. Just kidding.
No, but I really do think that the Keller mortgage thing was like a blessing in disguise for you, because you you may not have gone to Q, which would have introduced you to Tony, and then you wouldn't have been where you're at now.
It's been almost 2 years now at Synergy One, and it's been great. I've probably had the best and then from the beginning in 2023, like it was just a big risk to even make that move for anybody. Because then you go from like kind of a set thing to like, who knows what's going to happen. So it's like kind of it's really on you to like bring in your own business and, make your own money basically, because you're not getting a paycheck.
Hey, I have a question about that. That's for like any mortgage company. You guys aren't on hourly, or you are?
No,
is that
we're
TMI?
not. No, I mean it's good for people to know. Like,
because people know how we get paid. Obviously, we're 100% commission. Well, for the most part, if you didn't know, if we don't sell any houses, we don't have any money. We don't eat, and I'm a hungry girl. Anyway, so you guys are 100% commission too?
100% commission.
Really?
Yeah.
Oh, look at
And
that.
I went from Celerity to like Keller, Q, and all those. It's then you're going to 100% commission instead of
instead of an hourly with
or hours or salary, whatever. So it's a big change.
saying I have to send you more people. Oh my! Now you can send in people too.
I'm trying.
It was kind of scary when I left because like I said, I left when rates were like at their worst, and it was like the worst time in the market. Like,
and you're like, fuck, why did I do this?
And no one sees that coming. That was like 3 months later.
Right.
So everyone at that point was like, oh yeah, rates will come down and just wait another whatever. Like, but yeah, then at that point it got worse. So it was kind of scary, but yeah, luckily everything worked out, has been working out.
You're killing it now.
Yeah, you're doing great.
Can we ask, was this last year your best year?
This 2025 was, actually, it was better than 24.
All three of us.
2025
Was that
was
your
my best year, yeah.
your best year though? Like,
Ever?
or units and volume?
Or probably not higher than COVID.
Well, I guess it's different if I'm comparing like Celerity, it's like not the same because you just, people walk in,
Right.
you do whatever loan like people need at that
Oh,
point.
that's true.
You don't have to do anything for it. So I mean, on paper, I closed probably, I don't even know how many units.
The units probably more.
That's
What about like what you make? Did you?
Yeah, actually, I made more too.
Rich boy.
Just
kidding.
All three of
All three.
us. We all had our best
I
year.
know, yeah.
And this year,
Last year was pretty good. This year's been crazy for us.
crazy start.
We're working quite a few together right now. I think.
Yeah,
been
and that's another
intense,
thing too. Like then kind of after that, rates started to kind of like slowly trickle down, and then just the last year and a half, I guess we've had like some dips right now, which I'm sure you guys like felt it. Like a recent one was like earlier this year, where we had like a big dip where we were like under 6% for the first time in almost 4 years, and then that's when people like really came out.
Yeah,
and then we had something like that too. I think when we first, I think it was the fall of 24 when I first moved to Synergy, like in September, October, rates had almost dipped.
we were killing it that year too.
And then everyone,
like,
same thing, everyone came out and just that kind of spurred the rest of the year too. Those rates then kind of were hovering there.
Yeah.
So
what do you feel like? I don't know if you know this off the top of your head, but like right now, what do you think a 30-year fixed conventional rate looks like?
Right now, depending on credit, well, there's legalities with lenders, I guess, too, with that. But because on average, I think on an average scenario, a conventional, you're probably like at 6.125, 6.25. They did kind of spike up like a week ago, like almost a full 0.5%, more than 0.5%. So we touched those like low fives, and now we're like at
back up.
And then in some cases like 6.5 or 6.3, but they're still low relative to where we were for a while, like 7.5%.
And what's your prediction on where rates are gonna go, or what's the follow for the rest of the year?
A prediction. Everyone has a prediction.
I have a feeling they're not gonna move much.
Yeah, I mean, right
in
now,
either direction, maybe up.
There's a lot going on right now.
With like the war and stuff.
No, I know, but
look at our gas prices.
And that's what kind of caused all this, because we were right before the war. That's when we hit like 6.
But are we officially in like a war? I don't listen.
Yes.
I'm a girl. I don't really
like
know
on
what's
day
happening.
20.
All I know is my gas is more expensive.
It is
Anybody
more
wants to pay for it.
I did drive by the other day through Fred Meyer and saw it was like $4.98. So it was like 3 something.
Yeah.
I bought an electric car, you guys. I'm really happy now.
Yeah.
Well, I mean,
I wish we were like you.
You can make that move.
I know, you're right.
Depending on how long.
Right now, it does. Yeah, it does. I still have a diesel truck that I fill up occasionally, though, and I try not to drive it now.
So we are officially in a war.
So
That's
why is I
crazy. But
thinking
do you
if
guys want to buy a house?
yeah, if the war keeps going,
Mhm.
I mean, a lot of things are going to start happening here. I
Yeah.
mean, just today, like there's talks about like stopping the war and all
Mhm.
this stuff. So a
Yeah.
lot changes right now, day to day. That's where we see like
I don't think the Fed will
Big-
want to like make changes
No,
though
I don't
until
think-
the war has like been put to bed, right?
Mhm.
Like,
yeah, because I
Mhm.
think this spike in like it's going to cause like a spike in inflation again,
Right.
Right.
because of oil. Like,
Mhm.
I mean, transporting goods and stuff.
Yeah.
Usually
depends on that.
inflation rises when the cost of energy rises, so that's fuel and all that
It'll get passed on, but
the expenses.
the
Yeah.
Whatever that
expenses.
means.
So can you explain real quick, like why does the Fed raise rates when the world has more uncertainty?
Yes. So the Fed basically their job is to like control the federal money, like the money that banks use that they borrow from each other, like
Mhm.
basically on a daily rate or a daily kind of thing. So their goal is to keep the cost of that money either hot, like basically in line with like making it affordable, like inflation wise. Right now, with things being unaffordable, they want to try to not stimulate too much. So if they lower rates, it's going to make money cheaper,
Mm.
which means like people, it's kind of a big thing, but big picture thing, like people will have access to more
Mhm.
cheaper money, which
Right.
means they can
Which
buy
they can borrow more.
Right.
Yeah.
borrow more, buy
Right.
more,
Yeah.
whatever.
But they don't want
We
that.
don't want that right now because
Mhm.
then
And
it creates more of a price
Mhm.
inflation.
right.
Mhm.
And so for people to look back on COVID times during 2020, 21, and 22, the
Yeah.
reason
So the
why
rate-
rates were so
yeah.
low is because people weren't spending money. People were in saving mode. So
Yeah.
the Fed
It
and
was
the
like
government
huge
said,
true.
we need to stimulate spending. So
Mhm.
therefore, let's lower rates and get people pumping more money back into
Yeah.
the economy.
Yeah, so that's
Right.
like the complete opposite now of what we're
Right.
like.
Trying to do,
No
yeah.
one was like working for a while. The government didn't know, what was going on. Or
Mhm.
no one was spending money. And so then their goal is to like, well, we need the economy to keep running, so we have to put money into it.
Right.
And then they also did stimulus
Stimulus
checks
checks,
too.
yeah.
So that's literally free money. Like
Mhm.
you don't have to go borrow or anything.
Right.
And so then that's what kind of created the economy to, now looking like you'll see the economy like super, like got a super jump start.
Mhm.
And then prices. And so when rates are low, like we saw, I mean, I saw that's when I was at Solari and I saw
Mhm.
mortgage rates in the ones. So we were
That's
like at high
crazy.
ones, low twos. And then
I wish I was
That's-
buying my house then.
Me
which is crazy.
too. I
So
literally
it makes
bought
it
right
easier
before
for
that
people to
happened.
like, you guys saw it too.
Mhm.
Like people were offering 40, 50, 60,000 more
Mhm.
for a home that was like
Right.
kind of,
Mhm.
I mean, if we had the same rates and everything, with the way the market was going at that point, the price was like super cheap. Like that was a super cheap house because of the
Mhm.
rate.
Right.
And
Mhm.
so it was easy for people to offer so much more because
Right.
2%, like your payment's not going to go.
Right.
Right. Well, when money was cheaper to borrow, more people could afford. So therefore the demand was driven up, which is what ended up driving prices up because we ran out of inventory and then we needed more and that made the prices go higher. So that's kind of how we wound up where we are with higher prices these
That's
days.
kind of
But the prices I don't think go back down as much because
No.
the demand has gone up so much
Mhm.
that the prices haven't gone down even though rates have still come up.
Yeah, and that's like, I mean, the same with, I mean, anything you're buying now in the grocery store. Like usually when prices go up, like
They stay
they
up.
tend, they tend to stay up there. You don't really see like eggs aren't going to be that much cheaper like
Right.
next year and 2 years, 3 years.
Right.
It's always gonna because
Well-
once people are like used to paying that,
Mhm.
then it's like
They
no-
think
Why even
we might
lower
as
it?
yeah, why lower it when
Like,
people
people
are
are still
willing
gonna
to
buy
pay?
it.
Right.
Yeah. Yeah, that sucks. I think that was a good explanation, though. I think people should understand that. If you don't, obviously reach out to us so we can explain that
Yeah,
further,
send us a
right?
Send us a DM.
Yeah.
Send me a DM. Thank you for that explanation. That was amazing. So can you tell us a little bit about the different questions or different terminology that people might not know about? So like, what does cash to close mean? What is a down payment versus cash to close? I guess interest rate.
Everything.
People, yeah, like a little
Yeah.
bit about everything.
Get your dictionary out.
the most
Go through my notes here. No, so I mean, there's a lot of terminology in our world we use
Mhm.
and that buyers or consumers see too, like, and they're like, what is this? But yeah, so debt to income is one of them that people
Mhm.
a lot of people I would assume have heard it before, but
DTI or
DTI is
debt to
the slang or the shortened and hyphenated.
Mhm.
But But yeah, DTI is basically us looking at your total monthly debt and then comparing it to your total monthly income. As a lender, we're basically like minimizing risk, like how much of your money can we use, which in a mortgage is there's, and we'll get into that too, but there's two different. So there's also payment to income that I think we kind of focus more on that too on our side. A lot of people probably don't know about that one too much, but debt to income is your total debt to income, and then payment to income is your mortgage payment compared to your monthly income. So if we're focusing on a mortgage payment, the max that we can take someone up to of their income is 49.99. So when we look at their income, we're looking at gross income, and then we're looking at their debts that are in a credit report. So like an auto loan, which are our favorite ones.
Yeah, don't buy a Mercedes before you buy a house, guys. Although it has worked for us. It has. We had a buyer that went and bought a Mercedes, and then like a month later wanted to buy a house, and she did qualify, just not for the amount that she wanted.
Yeah.
She did get lucky because she did find something good. Yeah.
Auto debt, credit card debt. What about student loan debt?
Student loan debt.
Other home loan debt.
What about child support?
Child support.
That's one always I feel like gets caught like later on.
Yeah, I didn't know that.
I mean, it's not, because usually it's not on the credit report. So that's kind of a hard one for us to know, like, for certain.
But it will come up.
But it usually comes up.
Yeah. So don't think you can hide. It'll come up. Okay. Usually.
Yeah. We look at all of that. And really what we're focused on is the minimum payment. So we're not worried if you make more on it every month. It's focused on the minimum. So we basically get your total of what that debt looks like, and then add on your mortgage payment. So when we add that total, depending on the program, we can go to 57%. That's which we'll get into programs too, but every program or loan product has different ratios or limits to how much of that payment to income you can qualify for, and that total debt to income too. So that's kind of sometimes the harder part too, because we're also like working with this estimated payment, which has the actual like loan repayment that you're like have to make you have to make all of it, but it's a loan payment, and then your property taxes, which is initially at the beginning, it's an estimate of the whatever home you might get, and then insurance on the home, which that's also an estimate, and then mortgage insurance.
Oh yeah, that's PMI, right?
Favorite
PMI. I know that one, guys.
Yeah, so that's another one. That's and that is private mortgage insurance, which is basically insurance for the lender when you don't put 20% down or more than 20%, 20% or more. And that's where also the myth maybe comes from, that you need 20% down to buy a home, which you don't need 20% down.
Yeah, you don't. We've helped a lot of people that don't have that.
Yeah, I've had people with as little as $0 down.
Yeah, literally same.
No money down.
Even just a few $1,000s in your account, maybe less. You could get
you might get them back.
Literally, your tax return can probably help you buy a home.
Yeah. Tax returns. I've been seeing a lot of tax returns on bank statements this month, and actually, like a tax return really can change somebody.
New this year's tax returns.
This like the returns are starting to hit, and
that's good.
And it does change people's decision odds of approval too, because the more. Which we'll talk about that too. There's a lot to talk about.
Yeah.
When you have more money in an account, it looks better on a loan application, and the whole automated underwriting review and everything that we submit, it takes everything into account. Even like an extra $100 sometimes can change somebody's approval based on, because we'll look at how much money is going to be left over after you buy the house and after you do your down payment and cash to close. Those are some other ones, but yeah, that's what your payment is made up of. And then, it's an estimate. So when we qualify somebody, we kind of just wait until they find a house that they might like be interested in. Then we can really dial in the payment a little bit more. And then that's where we kind of figure out like what their total debt to income is going to look like based on that payment, and then based on that total debt too.
That sounds like a lot of work.
It is.
That sounds like I'd rather open the doors contracts. I'm sorry.
But like essentially when you're talking about DTI or whatever, you're just basically asking yourself, with all the expenses and debt that they currently pay on a monthly basis, can we squeeze in a mortgage payment for a house and still be under
Still be under.
49.99% because the other half their income is going to go towards their gas and their groceries, their utilities, and whatever they spend their money on a monthly basis. And you guys have ratios because you can't just let somebody use their whole income for a mortgage payment because then they don't have money to live, right?
True. Yeah. And they're taking into account risk at the end of the day with
Right.
everything on that loan.
Risk for the lender,
Risk for
yeah.
the
Because
lender.
if they're going to loan it, they don't want a foreclosure. It costs them more money
Yeah.
and they lose.
Basically, it's the big risk that they're trying to solve for is, will you make your mortgage payment every month?
Yeah.
And how long will you keep doing that? And that's why, and then it gets even more interesting from there because then that's how like rates get decided based on your credit score and then based on what kind of house you're going to buy, even like a regular, we call it a single, like a stick built house or a 1-unit home, just your regular home, or a manufactured home, 2 different rates that you'll get for that. If you're going to live in it or if you're going to rent it out, that's different rates because of the risk
And
involved.
usually down payment too, right?
Bigger down payment because it again circles back to risk. Like if someone was like if we go into recession with this for like someone has a house, their own house, and then they have maybe 2 rentals. Like, what are the odds that they're gonna stop making payment on their primary house?
Right.
It's usually like the first thing to go, like in the risk world. Of things. So that's why rates and fees and down payments are higher for that. Just
How do you remember all this?
Probably because you like
That sounds like a lot
these
of
are like factors
information.
you have to consider on a daily basis with every client you
pretty
have.
much. Yeah. As soon as as soon as I'm talking to a borrower, that's what kind of like goes in my head. And
Dang, that
so
sounds...
that's why it's interesting though. But it's like a puzzle that you're trying
Really
to
is.
solve and make sure that you basically your big thing is do you want to make sure that this person based on their application like all their information meets like the requirements or this box that this lender this product that they're going to go into like requires.
Right.
And if they don't, the cool thing about it sometimes that there's some like gray area sometimes with different guidelines and, which is good and bad I guess because sometimes it's subject to interpretation. And so in our world, we have someone that's the underwriter. Maybe people have heard about an underwriter.
I hate those underwriters.
Let's explain what the difference between an underwriter and you is too.
Yes. So an underwriter, so I would be considered a loan officer in the mortgage terminology world or an advisor. I like to advise people. So it's more of an advisement kind of thing, but I don't.
I'll remember that.
But yeah, then there's an underwriter. So that's the person that once I get their application in and review it, at first I basically give them a pre-approved or not. And if not, we'll tell them like, this is what you need to do to get pre-approved. And if you do these things, you have way better odds of getting pre-approved.
Yeah.
And then if they do it or not, then that's kind of them.
Can I tell a story about underwriters? I don't know if I can't say names.
Let him
but...
say what it is first so they know.
Is the person, someone goes under contract, or if there's like a really weird scenario that we're just like, this could go either way, we submit it to an underwriter, but they're the ones that will look everything over.
Like the fact checker.
All the documents, they basically have fact checking.
Okay.
And then if they see something, they're like, what is this? What's that?
Yeah.
They question things pretty hard.
Yeah, they do.
Sometimes, and there's a lot of underwriters that we use sometimes, or a pool of them, but we kind of get to know them somewhat well. So we know which ones are a little bit tougher on things and which ones aren't. Like it's the same, they're following the same guidelines, but then there's more questions involved. So that's the underwriter has basically the final say. Like if you submit your application or I submit a file to them and I like don't understand the rules or something and they catch it or they have a question about it, then I have to go back and explain it. And this is why it will still work. And this is why they work less hours this month and all that. And then it's kind of like putting a story together for an underwriter. I guess I kind of like put together this borrower's story and then present it to them and then make sure it fits all the criteria and yeah, you're approved. And they give the final stamp of approval.
Nice. Okay.
I'm sure they stamp too.
Yeah, probably so.
But it is, it's...
What's your
it's not even a story. It's just like, I'm glad that you're working with the company you work with now, because the previous one, there was an underwriter. I'm not going to say names, but God, everything was no, and this and that. And I'm like, girl, we just want to help them buy a house.
It was,
but
it
It was
Same person
it
every
was the
time.
same person every time. And at one point I really was like, oh
That's
my
the
God. Like, yeah, I was like, I'm not gonna send Francisco any more people.
No,
Yeah.
that underwriter.
You know who I'm talking about. She was a pain.
She was yeah, she was a pain.
She
but
was.
It was to me. It was like
Mhm.
it made me kind of question like me. I'm like, I'm reading this right here, like
Mhm.
because the rules and the guidelines are like
Mhm.
available to anyone. Like anyone can go download the manual and read it. Because there's a manual to like every, if it's FHA, conventional, VA, USC, and all that, there's a manual that has like their guidance on it. And like she would make me question, like, I'm reading this right here, and she's like saying no, but this, and that, and it was like she wasn't trying to make loans work.
Yeah, like it was so hard. I don't know.
It's easier to say no than have to figure it out type thing. That sucks.
Yeah, she did suck. No offense. I hope she's doing well now, though.
And this happened.
I wish her the best.
In a different career.
In a different career, though, because man, that was tough.
This happened after this. Wow, this stuff. Like, how did things change from where I left? You're doing the same thing. But then you kind of figure out like, oh, it's not. It's a person now.
I thought it was you for a second. I was like, I'm gonna have to cut him off. I'm sorry.
Yeah, she made me really sharpen up on my arguments because
that's good.
Oh yeah,
you do need that sometimes.
You do.
They can look at it a different way, but if they like, I don't know, miss something, they didn't read something correctly. Sometimes it's that they just miss something, and you just gotta look. Here it is.
Point them out. Yeah.
Or sometimes it is like, let's get some more. Sometimes you do have to get more info from the borrower, and like have them explain like why something happened.
If there's anything that constitutes as proof, that's what they're looking for. That's what they need.
Yeah, essentially they want to also. So what happens on the back end of things after an underwriter, like after we close a loan, like basically every mortgage in the world, like an investor buys it. So like they basically pull up all these loans, and then like a big investor will buy it, and they want to make sure also the same thing, like that they guarantee like some sort of payment. Not every loan in there is going to just fall apart after
they take over after they buy.
So do you guys sell your mortgages?
We keep some of them. We sell most of them because that's how pretty much you're able to do more loans. And that's what usually every place does. There's places that don't sell them, like smaller places, but which I came from a small place. And so I can tell you that when you're doing loans there, like they have extra restrictions on top of like the manual that's online or the guidelines.
So like a credit union would have more restrictions?
And because it, again, kind of a risk thing for them. They want to, whatever at the end of the day, financial wise, they want like to minimize risk. Sometimes they'll lower the debt to income limit. So they won't let you go up to 49.99.
Right.
Or
they have higher fees.
Or higher fees, different credit requirements. Sometimes I remember we had a product at Slurry, they wanted to like prove like certain, like a history of rent payments for everybody. And you don't really need that unless the actual program calls for it. Which sometimes it does, but that was for like every single one.
Oh, dang, that would be tough.
So yeah, usually they have higher, what we call overlays. So on top of just the regular stuff, they put extra stuff.
So essentially when somebody goes to like, well, it's happened to us where we have a buyer that was previously with the credit union and then you quote them, but you approve them for more. That's why.
Part of the reason. Could be, it could be that, or it could be like, every lender's different. So like everyone has a different understanding of these guidelines or rules. So maybe they just missed something, or there could be a lot of different things, but that or that. But that's usually what happens because the bank or the credit union, they're not going to sell it to anybody. They're just keeping it. So they're trying to minimize their risk.
That makes
what are the odds that they want less risky loans. So they add some extra stuff to minimize their risk at the end of the day.
So real quick, I think that reminded me of something because when I bought my house, I had a tough underwriter as well that would make me get letters for everything. It
was probably the same person.
No, it wasn't from that company.
Like,
I used a broker for a loan, like because it was a bank statement loan. It wasn't typical, conventional loan.
Sometimes a little tougher too.
It was hard. It was really hard. And so because it was a broker loan, I feel like that added complicated things to it. But they also, the tough underwriter made me get letters for everything. Like they have me get letters for like the last 2 or 3 years of places that I lived at. My mom had to write letters because when I moved home from college, I lived with her for a little bit.
That's crazy.
And then, there was just a whole bunch of things there. But one of the things is after I closed that, they did sell my loan and it went to a different servicer. And then my loan was sold again and it went to another servicer. So it changed a lot of times. And then I eventually refinanced. And that was all within 6 months from buying a
Damn.
house.
Oh, well.
And then I've been with a company that I refied with because they keep their loans.
Yeah, usually like if you're doing a specialty product like that or a non-QM, which is a qualified mortgage, usually they have way different rules and then way more, requirements on
Restrictions.
top. And then their servicing of those loans is like probably it's not even good probably. Then they just
No. Oh my God.
recycling stuff.
So actually, this is kind of crazy. The servicer that they passed me off to is called, I'm gonna say it too. It's called Celine Mortgage.
Sounds like someone's grandma.
They forgot.
Just kidding.
No, they forgot to pay my property taxes.
No way.
Yeah, so I got fined from the county for not paying my property taxes
shit.
and they were collecting them in an escrow account.
Wow.
So
Yeah,
I was
that shouldn't
so pissed.
that should
And
not
then
happen. Yeah.
I just refinanced my house, or was like starting my refi, and my lender was like, "Did you not pay your property taxes? Like, I'm kind of surprised that wasn't done for you." And I was like, "No, there's an escrow account." She's like, "Well, they weren't paid," and so she's like, "We'll pay them up as part of like your refi, like it was included." And I ended up having to pay all the late fees with it.
Oh, that sucks.
Couldn't argue it.
Yeah,
I was so ready to be done with it. I was like, I'm not even gonna argue it because they'll take a week to get back to me.
Yeah, that's what I was gonna say.
But that was crazy.
It's crazy.
So, and that actually was one of the terms I was thinking would be good to explain. What is an escrow account? Because when we're shopping for homes and you get under contract, we work with title and escrow, which if you guys remember back to the episode we had with Rachel Stiles, we talked about what escrow services are. There's a difference between having an escrow account with your mortgage after you've bought the home. And so what is that?
So an escrow account is basically an extra savings or a savings account, I guess. Technically.
That you don't really have
You don't
access
really-
to.
Yeah, you don't have access to it. You'll see it on your mortgage statement. Like this is it, where you'll see like escrow balance. You'll see it change every
They're
month.
saving money.
Saving money. So usually every time you make a mortgage payment, there's a portion in there for your property taxes and your homeowner's insurance. So every time you make that payment, that amount goes in this escrow account. And then that's where your servicer, your lender will draw money out and pay your insurance and pay your property taxes from. So you're paying it every month or budgeting for it every month. And then when the bill comes, usually goes to them. Usually you'll get like a copy of your insurance every year, but it's not, you don't have to pay for it, but they'll pay it. And then basically that's where your property taxes and insurance are paid from. But at the beginning of everything, when you're buying a house or when you're refinancing your loan, if you still don't have 20% or more of equity in your house at that point, then usually every lender has to collect for it because it's kind of again a risk thing. Like they're not going to let you make the payment and let you put it in collections and all that stuff. But yeah, once you hit that 80% mark, then you can do it on your own. But in the meantime, that's where you'll basically at the beginning when you're about to buy your house, we'll collect whatever your homeowner's insurance quote is. It's $1,200. We'll collect that as part of your closing costs. So when
That's what they call reserves, or no, that's not reserves.
No, that one is technically your actual like premium that's due. But then we also collect like usually it's 2 months of the homeowner's insurance as a cushion for your escrow account. So we fund your escrow account with those extra 2 months right at the beginning when you buy the house. And then kind of the same thing with your property taxes. That one's a little trickier because depending on what
it
time
depends
of
on the
year,
timing, of the year when they're due.
Sometimes we don't have to collect anything extra, or we usually collect 2 months just to have the escrow account have a kind of a buffer. But then if you're buying, like if you're closing in April, for example, I think right now, property taxes are due April 30th.
Right.
So if you're closing in April, I think we only collect two months for the reserves, and then 1 month I think to basically by the time you get to October and make all those payments, you'll have 6 months worth of property taxes for the servicer to pay out. But yeah, the escrow is what we'll collect at the beginning, so it's part of your closing costs, which sometimes it can be a lot, especially again depending on the time of the year that you close. I mean, let's $1,500 for insurance, and then at least like. Sometimes it's low, but you can
$2,000 or $3,000 for property tax.
Yeah, I've seen them pretty high.
That's part of what someone will pay as a closing cost. So it's a fee, I guess you could say, but it's not like a lender fee. It's what like anybody's going to have to collect this exact dollar to basically make sure everything's ready for the due date. That's a
Yeah.
down payment.
Sounds expensive.
It
Not-
is. You know, I sold a house in Natchez once. It makes me wonder if Natchez has higher property taxes because some of the cities, like sub-cities outside of Yakima, can also have a little bit of jurisdiction on their property taxes, I think,
Mhm.
and excise tax too. But I sold this house in Natchez. Their property taxes were over $8,000.
No way. How much was
The house was 600, but it was
Oh,
also
okay.
6,000.
Okay.
Like,
Well,
I
that makes
think-
sense.
and I've never seen them that high. No,
That's
too.
crazy.
Like 4,000 or 5,000 seems more reasonable to me, but
Yeah.
that was crazy.
I was looking at a listing that popped up this last weekend too, and it was like $8,700 for the property tax.
Damn.
That's like I think it was like $700 a month if you were paying it.
Oh my gosh. That's crazy.
Yeah.
Which
That's expensive.
it's
Yeah.
factored
That's,
into your mortgage payment. Though.
yeah.
And I think
Ooh.
the cool thing about having an escrow account is it doesn't cost you money to have
Right.
that set up. It's just part
Mhm.
of it.
Yeah.
It's a lower risk factor for you, and the
Mhm.
lender's willing to do that for you.
Yeah, it's,
So
I
it's
mean,
a
it's a free
win-win, I
service.
feel like.
Yeah.
Which is a cool service, I guess,
Yeah.
for people because then you don't have to worry about it.
You just forget.
earn,
Yeah. I
like,
feel
And
like
we're
that's
sending it.
exactly why we call it a servicer who services your loan
Yeah.
Mhm.
to make sure that they manage your escrow account
Yeah.
and make sure that they're managing your payments.
They're paying it on time. Yeah.
Yeah, cool.
Cool.
What is, I mean, broadly, can you explain what homeowners insurance is? Why is it required? And
Yeah, so kind of a risk thing again.
pretty much.
Pretty much, it's all risk. If you have a loan under your house, we're always going to require it in the case. Well, homeowners insurance is going to cover you as the homeowner if there's like damage to the home, it's like
Right.
significant damage to it. So basically, that ensures that if you didn't have homeowners insurance, like what are the odds that you're going to
You're still responsible
your
for the
own-
debt you
Mhm.
have. Yeah. And you're out of home.
Yeah. So
Yeah.
then the insurance makes sure that the home, to a certain extent, stays in good condition, like for the life
Right.
of the loan.
Mhm.
Yeah. When you own your home pretty you're not
You're not required
have
to,
homeowners
but
insurance.
if
But
it's,
still
if it's worth
smart,
500
right?
Yeah.
Yeah,
If it's like
it's so
500
smart.
grand and then it burns down, that's like throwing away $500,000.
Literally.
But I've
Literally.
helped
Yeah.
people when they come back and they're like refinance something like that they didn't have insurance on their house.
Wow.
It's kind of, I guess, kind of normal sometimes, but it happens. But it is a risk.
That is a
That's
huge
hard.
risk. Yeah.
People do crazy things. Like if they're in a pinch for money, they'll cut things out
Yeah.
that are still really important.
Yeah.
And insurance is one of those things that is expensive.
Mm.
And if they need money, that's one of the first things they'll probably cut.
Hmm.
So that's crazy.
Yeah.
All right. What is a down payment?
The down payment.
Yeah.
That's the big one.
So down payment versus cash to close. What are the difference between the terms?
Yeah. So your down payment and your cash to close, basically two different dollar amounts that you're going to need usually to buy a house. So your down payment is going to be what you're putting towards the actual price of the home or your loan.
Towards the principal.
Yeah, towards your like loan amount. That because usually we start at the price of the home as your loan amount and then reduce it by how much you're putting down. So it's essentially your commitment to the loan to start. So normally your down payment will vary too based on the program that you qualify, but the lowest starts at 3%. So that's what you're putting down to reduce your loan amount. So if you're buying a $500,000 house, your loan amount's going to be $485 for
Mhm.
3% of 500 is 15,000, I think. Pretty sure
About.
it is about.
We're not the math. group
I'm
for this.
like, I don't know.
But that 15,000, we'll use that as the example as the down payment. And then the cash to close is a combination of your down payment and your closing costs. So closing costs are your basically your second chunk of money that you're going to need, which covers quite a few things like your appraisal, all your title paperwork, all your escrow paperwork, your insurance, property taxes, credit report fees, processing, underwriting, all these
Mhm.
fees.
Origination fees.
Origination fees
Yeah.
sometimes.
That's usually
Your
big one.
points, if you buy discount points, like if you buy your rate down a little bit,
Mhm.
points, every single fee basically from the loan within
Yeah.
the loan. So that's usually that'll vary just depending on your loan amount or what property you end up purchasing or the taxes on it.
Mhm.
But usually it's like 3 to 5% of the loan.
And it
Right.
does not include your commission fees, our commission fees.
Unless
Because
it's for the
people-
seller.
People always,
Well,
unless it's for the
sometimes
sellers.
for a buyer, but not.
But for the most
occasionally.
part, I
Yeah,
don't
it
think.
doesn't happen.
Yeah.
Yeah, I
I've
usually
never
tell
done it.
people that like closing costs are the costs to make the sale happen.
Mhm.
I mean, you're paying for the process basically.
Yeah.
The
Yeah.
process is not free, so you're paying to go through this process to make the sale happen. It's not money that goes towards equity in the home.
Mhm.
It's just simply the
Fees
fee you pay
Right.
to
get
make it
started.
happen. It's like, let's say it's like when you buy a car, you have other taxes and fees and stuff
Mhm.
that you have to pay. Those are essentially a closing cost, that doesn't mean the car is worth that much more, right?
That's true.
Yeah,
So,
and the cool thing about closing costs though is that the seller can help you cover all of it sometimes, a
Right.
chunk of it.
Right.
Versus the down payment, usually, I mean, the down payment has to be from your own money or a gift from somebody, or a down payment assistance program, like that can't come from the seller. But yeah, you can kind of cut your costs in half if you're able to get a seller to cover that half of it for you too.
Yeah.
So that helps minimize. It's pretty substantial, like what someone's going to need to get into the house.
well, we've covered a lot of terminology. So if you have any questions on other terms that you're hearing in your process, or if you're wanting to buy a house and you want to kind of recap these things, please let us know. We are going to move on to part 2 where we talk about different loan products. So stay tuned for next week. We've got some good stuff coming.
And that might be the fun, juicy episode 1 too.
Yeah.
With all the drama. You'll have to keep waiting.
All right.
Bye.
Signing off.
Bye-bye.